Hello, I'm Kevin Miller. We're going to talk today about the evaluator funds, their performance, how Morningstar has basically changed the categorization for these funds extensively over the last few years, and how the markets have performed for the first half of this year, and how we see them performing the second half of this year going into 2026. So if we look at the agenda, we're going to look at benchmarking. We're going to look at how the evaluator funds have their stock allocation ranges established. We're going to look at Morningstar's category of the history of these asset allocation categories, Secure Act that was passed by Congress in 2022. We're going to look at the performance of the evaluator funds. We're going to look at the overview of the first half, talk a little bit about the Federal Reserve, and then what might make the stock market go higher in the second half of 2025. So if we look at benchmarking, the first thing we need to identify is evaluator funds equity allocation ranges. And as you can see in this slide, we identify each investment equity allocation as a range. So very conservative, that investment could have as little as 0% in stocks, or it could have as much as 15%, but never more than 15%. The conservative would have anywhere from 15 to 30%. Conservative moderate would have 30 to 50% in stocks. The moderate always have a minimum of 50, but never more than 70. The growth would always have a minimum of 70, but no more than 85. And aggressive growth would have at least 85, but never more than 99% in stocks. The reason we do this is because everyone's definition of moderate is different. Everyone's different definition of conservative or growth is different. So here we're just identifying the range that these investments will have in stocks at all times. So you as the investor can discern whether that's a range that is comfortable with the purpose for you to invest money in these investments. You'll see these ranges are described in the name of each fund. It's in the parentheses, so it's very visible for you. So not only do we show you the equity allocation range, but I also want to communicate to you that the amount that is not invested in equities would be invested in fixed income. And that would include bonds and money markets. So the right component of this table shows you the fixed income range that each of these investments could have at any one time. So if we look at the history of Morningstar's categorization for these type of investments, back in 2013, they had three categories: conservative, moderate, and aggressive. And you can see the definition they use for why they placed an investment in this category. 20 to 50% in stocks for conservative, 50 to 70 for moderate, and 70 to 90 invested in stocks for aggressive. And you can see the investments of ours that they placed in each of those categories. Then in 2016, they expanded that list to five more categories. They changed the names and they changed some of our investments, moved them to these new categories. So they had a category that was called allocation 15 to 30% in stocks or equities, allocation 30 to 50, allocation 50 to 70, allocation 70 to 85, and allocation 85% or more. The difference between our investments and this approach was our investments are finite. When we say 50 to 70% in stocks at any time, it'll never be below 50 and it'll never be above 70. Morningstar's approach was to take a 3-year average, which is fine. It's close, but it isn't an apples to apples comparison, but it's really, really close. So we were good with that. Then in 2022, excuse me, I had to show this at a little bit bigger level so it's easier for people to see. Then in 2022, they changed the definition they added to the definition as to how they identify what investments belong in which zone or which category. And the component they changed, they included expected volatility. Now, I don't know how anyone can discern what the expected volatility of an individual stock or mutual fund is, let alone what the whole market's going to do in the future. But that wasn't something that they incorporated into their matrix for establishing investments in various in various categories. As a result, they moved some of our investments into different categories. And so at this point in time in 2022, half of our six investments, the three of our six, half of them were miscategorized. Now, this created quite an issue within the industry, and there are several complaints because there are mutual fund companies having their funds being moved all around based on the fact that Morningstar was looking at their investments saying, well, we expect your volatility to, resemble an investment that is invested in this manner, regardless of how it's actually invested. It's kind of interesting, but also in 2022, that's when Secure 2.0 Act was passed. It was signed into law on December 30th of 2022. Now, I don't know if a component of that pertains to asset allocation benchmarking, if Morningstar's changes led to that section of Secure 2.0 Act, which we'll discuss in a little bit here. But I just want you to know that there is a combined impact, and once we had half of our investments inappropriately categorized, then we started using what Secure 2.0 Act was suggesting or recommending for benchmarking for asset allocation funds, which you'll see here shortly. In 2023, we experienced another change. They changed the names again to the categories, which wasn't a big deal. But then they also added a prioritization component to defining what funds should go into what category. So since 2016, they broke it down by percentage invested in stocks, which was good. Then they added the expected volatility component, which was somewhat puzzling. And then in 2023, they added this prioritization component to defining what fund should fall in what category. Well, and you can see what this looks like. Again, compliance wants us to make this page a little bit bigger so it's easier for people to read. And so that's why we double click on these columns. So 2024 actually is about April or May of 2024. I reached out to Morningstar and said, hey, you've got two of our investments completely miscategorized, and our investments are not that volatile, yada, yada, yada. And so then they agreed in July of 2024, they moved two of our investments back to where they originally were back in from April 2016 through April of 2000 or up through March of 2022. And that's all we're showing you here is that these investments got moved back to where they should have been and should have never been moved out of. Then this year, they made additional changes. They decided to come up with a global component to their categories for asset allocation funds. So they created a global conservative allocation category. They created a global moderately conservative allocation category. They created a global moderate, a global moderately aggressive, and a global aggressive allocation category. In order to create this new category, they had to take investments from the existing categories and move those investments over to the new global. And in some cases, they moved as many as 59% of the investments in the existing category into the new global category. The lowest amount they moved was about a third. Well, when you start moving investments of that magnitude from one peer group to another, that's going to dramatically alter the average return of that peer group. And, I made a point to show you that we're talking about 10-year returns. Well, it takes a long time to alter your 10-year return. So if overnight from April 30th to March 1st, all of a sudden the total number of investments in your peer group has dramatically changed, it's going to dramatically change the 10-year average return instantaneously in one day. But the funds it's going to take 3, 5, maybe 6 years before those funds can change their 10-year return, just because it's such a long time horizon, you can't change it over a short period of time. With all these changes, we felt very good over the fact that we made adjustments to move away from using Morningstar as a peer group identifier for our benchmarking back in 2022 and went with what was brought forward in Secure Act Secure 2.0 Act, Section 318. Basically, what that 318 calls for is that you can use a blended performance of indexes as long as these indices are appropriate for the investment's asset classes. So you got to identify the asset class, then you identify the index to represent that asset class. You identify that the investment's asset allocation is identical to what you're showing across the benchmarks over a period of time. And you have to at least update that asset allocation once a year. Ours is updated on a regular basis throughout the year. I probably a weekly basis throughout the year. So it's updated much more frequently than just once a year. So the asset classes that we chose that represent the underlying holdings in our funds were money market, bonds, domestic large cap stocks, domestic small to mid cap stocks, and foreign stocks. The indexes we used to represent these asset classes was Morningstar's money market category, Bloomberg US Aggregate Bond Index. For domestic large cap stocks, we chose to split half of that allocation into the Dow Jones Industrial and half of it in the S&P 500. Some people prefer following the Dow. Some people prefer following the S&P 500. We're just saying we don't care. We'll just use them both. So then we're not, siding on one side or the other. For domestic small to mid cap stocks, we're looking at the Russell 2000. And then for foreign stocks, we're looking at the EAFE index. An explanation of these indexes are right down here. So you can take the time and view that if you'd like. So now, with that being said, let's look to see how we actually manage the equity allocation ranges of the evaluator funds. So when we are cautious and we think the economic outlook isn't really quite robust and it could be concerned for a potential pullback, we will typically keep the equity allocation range of each fund in its lower, third, 35 percentile of the range. So if the very conservative range is 0 to 15%, we'd have the equity allocation for that fund to be between 0 and 5%. If the conservatives range is a minimum of 15 to 30, and we were cautious, we would keep the actual allocation between 15 to 20%. So what we're trying to say is that when we think things are less certain or less probable, not real great looking forward, we will reduce the amount of equity allocation into the lower third of the overall range for each fund. Then if we're kind of neutral and we think, it could go either way, it's not too bad, it's not too great, little bit of uncertainty, but not overwhelming, then we would have the equity allocation kind of be in the middle of each fund's range. And then if we were quite growth oriented, we thought there's things being put in place that over the next year, 2 years, 3 years could promote a very positive market outcome, stock market outcome, then we would have the equity allocation pretty much being in about the top third of each of the ranges for each fund. Now, again, you'll see the name in the naming convention of each fund, you'll see the minimum and maximum stock allocation range. But we also, as part of the management perspective, are adjusting how much we're allocating into equities based on the information we're receiving with regard to future outlook of the stock market. So now with that, let's look at the performance of the evaluator funds as of 6/30. Very conservative. By the way, we'll use a color coordination on these investments, purple, blue, green, yellow. We're coming out with a software that where this color coordination will be very apparent and needed. So we're just incorporating this color orientation at this case, and we've been doing this for many years. But there's a reason why you'll see these different colors for these different funds. So the very conservative purple, in the lower left-hand corner, you'll see the amount that is dedicated to these asset classes. Money market 1%. This fund currently has about 84.8% invested in bonds. It has a collective total of 7% invested in domestic large cap stocks, 4.7% in small to mid cap domestic, and 2.6% invested in foreign. So then we look at the indexes that we've already identified we're going to use for these asset classes. You take those percentages allocated into each asset class times the index that represents that asset class, put the result in a column, total it up. Since this is for 1 year, the 1 year return of this asset allocation across these indexes would have equaled a 3.36% return. And that's what you see up here in the gray row at the bottom of the table in the middle of this page. Now, benchmarking is purely provided for comparison purposes, for you to see whether the investment you're investing in is performing as well as or better than or worse than the benchmark, and then also so you can measure some other elements like maybe volatility, etc. Well, the performance of the investment is the row right above this benchmark row. And so you can just look at the 1 year return of the investment and compare that to the 1 year blended return of the index. Year to date, 3-month, 3-year, 5-year, 10-year returns. So it's very easy for you to identify, well, is this investment keeping pace with the market in general based on the asset allocation that it has within it? The last 3 columns pertain to standard deviation, and that's a volatility measurement. And typically we want our standard deviation less, lower, a smaller number, because then it would indicate that in the event of a market sell-off, we would not participate in that downturn as much. There's no guarantee, but that's typically what we're trying to do is keep that lower. So if the market does pull back, hopefully our investments won't pull back as far as the general average investment. The thing to keep an eye on over the next few slides is right down here where it says fixed income or bonds. That number is going to proceed to get smaller as we go through because we're going to look at investments that steadily increase their equity allocation. So like the next one here goes to 69.8. That's because this is the conservative fund. It has 15 to 30% in stocks. Currently, it has 29%. Again, take the percentage it has dedicated to each asset class times the index, the performance of the index that represents that asset class, and add up the result. In this scenario, the 1 year blended return would have been a 4.76%, which you see under the 1 year column in the gray shaded area. And then you can just look at the return of the investment, the actual return of the investment, that is the row right above the benchmarks header. And you can compare those just to see if the investment is performing at a level that is as good, maybe better than, maybe worse than the benchmark. Now, again, the last 3 columns are standard deviation. We typically want that below the average, and that has been the case that we've experienced for quite some time. The conservative moderate has anywhere from 30 to 50% in stocks. It has about 50.3% in bonds and 0.8% in money market. Its 1 year blended index performance was 6.59 as of June 30th. And you can see the other returns on a blended basis for the various timeframes at the top of each column. You can see the performance of the investment relative to that of the blended indexes. The other point I want to make is that these returns that you see in being posted here, all of these returns are net of the fund operating expenses. So these returns are net of all fees. So this is what you're getting in result in comparison to what you would have received with an identical asset allocation invested in these indexes. The moderate, about 30% in bonds, another 0.5% in money market. This will have anywhere from 50 to 70% in stocks, currently 69%. Same math methodology, take the allocation percentage times the return for that index, total it up. The blended 1 year return for the asset class performance would have been 8.35% for 1 year. And you can compare, again, the performance of this actual investment to the blended benchmarking returns of the indexes as identified in this, according to this fund's asset allocation. Standard deviation is below the average, which is what we're shooting for. The growth fund, probably the investment that has the most assets of all six of our investments, 70 to 85% in stocks, currently has 84. You can see it has 15% in bonds, another 0.5% in money market. The 1-year indexed return was 9.74% for this fund. You can see what the 1 year of the return of the investment actually was as of 6/30. You can see all the performance just like you have in the previous four. You can see the volatility relative to the blending of the indexes, again, pursuant to Secure 2.0 Act, and everything looks good. And then lastly, the aggressive growth, 85 to 99% in stocks, currently has 98%. Very little in fixed income or bonds. You can see the blended return would have been 10.84 across these indexes compared to the actual 1-year return. What's interesting is, if you look year to date as of June 30th, not only can you look at the blended return in any of these investments, but you can say, okay, this fund's year-to-date return is 8.31. How does that match up with the money market's year-to-date return, or the bond category year-to-date return, or the Dow Jones Industrial at 364, or the S&P 500 at 55, or the Russell at negative 2.47? How did we get 831 when those are not as strong? Well, this is a diversified investment, just like all the rest of them. This one has 19% in international stocks. So in this scenario, year to date, foreign stocks have really performed quite well, and we would have participated in that as well. So the reason our performance has been relatively strong is because the underlying selection process, the asset allocation that we apply to these investments, and then the diversification also helps with the overall performance. This is just a disclosure page that compliance wants us to show. I'm just going to wait a couple seconds here. You can easily stop the video and read through this, but it's just basically typical information that we have to provide. Discuss performance history, risk, and standard deviation. Goes through the operating expense of the investments, etc. Okay, so now let's talk a little bit about the market, what happened in first half of 2025, and where we think it might be going. Obviously, back in April, the stock market pulled back. At that point in time, we increased the equity allocation across all of our investments. We're seeing the stock market this year perform on a more broad basis as opposed to just 7 stocks as we'd seen for the last 2 years. We've seen consumer sentiment did hit a bottom, and we've seen an increase in money market assets. So this represents the S&P 500 from January 24 through July of 25. Right in here is where we saw that big sell-off. And that sell-off got as low as the market was previously back in February or April of 24. So by anyone who deposited money on April 8th of 2025, that would have been the same. They would have bought in at about the same level as they could have back in February or April of 2024. So these are pullbacks you look for when you feel the market might be a little overpriced, and you can forego that volatility, wait for it to come back, and then get in at that time. One way we track it is we track 4 different indexes, the S&P, the Dow, the NASDAQ, and the Russell, and we identify when they've hit their all-time high. And then when we see their performance drop on average by 20% or more, we feel that's a good time to get in. Okay, and it's a triggering effect. And so we saw on April 8th that the blended performance of these 4 indexes from peak to trough on April 8th was down almost 22%. Now we can look back and we can see that from April 8th until June 30th of 25, how these have recovered. And because on April 8th, this is where they were at the bottom of the trough. And then on June 30th, this is where they ended up at the close of June. So you can see the amount of recovery that they've had. And on average, these four have averaged a 24.77% gain in a very short period of time. Regarding the breadth of the market participating, if you look at this little square rectangle right here, you'll see that the Magnificent Seven, which is right here, these seven stocks, Apple, Amazon, Google, two different shares of Google, Meta, Microsoft, NVIDIA, and Tesla, those seven stocks were really carrying the stock market the last 2 years. In 2023, those seven stocks were up 76%. In 2024, they're up 58%. The other 493 stocks of the S&P 500 identified in blue were only up 8% in 2023 and only up 10% in 2024. So basically, the market was carried by these seven stocks. So what's happening year to date through June 30th, 2025? Well, the Magnificent Seven are only up 3%, but the other 493 stocks are up 5%. That's what we're trying to say by their stocks that weren't participating in the overall performance of the stock market the last 2 years are now starting to carry their own weight. And that's a good thing, because what that can do is mitigate a lot of volatility, and it can help strengthen our economy, and it can help strengthen the returns that we're getting out of the stock market. Another thing that we keep track of is consumer confidence, because we are a consumer-driven economy. 67% of our economy is driven by consumption from individuals and corporations. You can see that whenever this line drops below 60, which we identified with this colored line, you can see that the next 12 months, the stock market has done historically quite well. In 75, 12 months later, February 75, 12 months later, the stock market was up at 22%. In May of 1980, after it hit its bottom, it was up 20% 12 months later. In November of 2008, it was up 22%. August 2011, after it hit its bottom, it was up 15.4. In June of 2022, it was up 17. You can see where it was in May of this year and where it is now in June. It just creeped back over that 60-point line at 60.7. We don't know where it will be, in another 10 months or so, but this gives us some indication that, based on historical perspective, when we see this reading get this low, typically it's a positive outcome. Historically, it's been a very good outcome 12 months later. And so that also gave us incentive to increase the percentage of asset allocation into equities, in addition to some of these other indicators we've already discussed. Another thing that we think is really healthy for the stock market long-term down the road is the amount of money we have in money markets. We've got $7.4 trillion, rounded up to 7.4 trillion, in money market assets. Why is that potentially a positive? Well, if the Federal Reserve does start lowering interest rates, that's going to reduce returns on money market accounts. And at some point in time, if money market interest rates get so low, people will take money out of money markets and start rolling it back into of multiple different places. And one of them could be the stock market. So we view this as potential new assets that could be reintroduced back into the stock market in the not too distant future, depending on what the Federal Reserve does with interest rates. Speaking of the Federal Reserve, right now we have $36 trillion in debt. We're currently paying about a 3% interest on that debt. We're going to have $9 trillion of this debt mature in the last half of this year, last half of 2025. So that money is going to get renewed at a higher rate. Because of those higher rates, it could increase our interest payments by several $100 billion a year. That is probably the most important reason why the Fed should lower interest rates. Another reason is consumer price index, CPI, and producer price indexes are all at acceptable levels. So let's look at the graphics on this. So this represents the total amount of debt we have right now as a country, 30, and then this doesn't include Social Security and Medicare and Medicaid and all that other stuff. But $36 trillion is what we're showing of debt, total public debt, and this comes from U.S. Department of Treasury. This is the total amount of annual interest that we pay on that debt, 1.1 trillion. So if we take the annual interest, 1.1 trillion, divided by the total debt, our blended rate is right at about 3% right now. But most of that debt that's going to be renewing the last half of this year was issued probably between 2014 and 2020. And if you look at the Federal Reserve funds rate, you can see how it goes up and down, and you can see where it was during that period of time when the debt that's about to mature was probably issued in that window. And you can see that most of it was below that first gray line, which means most of it is at less than 1%. So when that renews, if interest rates don't change at all, it's going to renew at about 4%. So we're going to go from a fraction of 1% on a lot of that debt to it reissuing it at a level that's around, let's just say around 4%. That is a substantial increase, and that's why we're saying it could potentially increase our interest expense by several $100 billion. In my opinion, this is the number one reason why we all want to see the Federal Reserve to start lowering rates. This shows you the CPI, Consumer Price Index. Now, this is as of May 31st. It takes a little time to put these videos together. We have to take, the data, get it approved by compliance. Then once it's approved, then we come back, we put the video together, and then we get it out. And a lot of things can change from the very first day that we start putting this together to now, especially in today's world with seems like every day we wake up and there's something new to discuss. But the point is that CPI is right around that range where the Federal Reserve has historically said that that's their goal, around 2 to 2.5%. PPI, which is the producer price index, that's in approximately the same area, mid twos. So what we're seeing is that the Federal Reserve really doesn't need to keep rates as high, and by lowering them, it will help stimulate the markets and prolong the economic growth that we've experienced for the last several years. So what could move markets higher in the last half of 2025? If we continue to reduce wasteful spending via the DOGE program. Now, when I put this slide together, the tax bill hadn't been passed, but we anticipate lower income taxes, no taxes on tips, overtime, Social Security, which will provide more spendable income for individuals. And since we're a consumer-based economy, that is just going to encourage people to continue to stimulate the economy through their expenditures. Increased tariff revenue. Since the initial setup of this slideshow, we've seen a fair number of tariff deals come through already, and there's still some remaining, but the expectation is that by early to mid-August, the vast majority of them will be completed and established. If you look at Trump's first 4 years, one of the things he did is he minimized regulatory easing, helping businesses get plants built, helping investments into economic development. And I would anticipate that you're going to see that exact same thing in this term as well. We think Federal Reserve will lower interest rates. We're seeing a substantial number of stocks that have not actively participated in the stock market for the past years will begin to participate. And I pointed that out to you in a previous slide. Another thing is if you look at his first 4 years, he increased energy production and driving down the price of energy drives down, it's very anti-inflationary. I mean, it drives down the cost of building products. It drives down the cost of manufacturing. Obviously, it drives down the cost of delivering, groceries to grocery stores. So this is a huge component to maintaining inflation at a low level. And then also, depending on to what level, if and or when the Federal Reserve lowers interest rates, if they lower interest rates relatively fast, or if they, just start lowering them, that's going to reduce the returns on money markets. And with $7.4 trillion being currently held in money markets, we could envision some of those assets getting pulled out of money markets and back into the stock market, which would be a strong thing for the growth of the stock market. So with that, that's all we have to discuss with you today. Very much appreciate you taking the time to view this. Please feel free to reach out to me if you got any questions. And thank you for taking the time, and thank you for the opportunity to manage your money. Hopefully you have some of it in these funds, and we'll keep doing the best job we can. Thank you.